Welcome to the deep dive. Picture this, a country that's, a global financial heavyweight, a real source of stability, liquidity for international markets.
Mm-hmm.
But at the same time, it's grappling with these really deep internal struggles. It's quite a paradox, a fascinating one, really, and something we need to unpack. So today we're taking that deep dive into Japan's financial stability. We'll trace its journey from that incredible post-war growth right through to its current vulnerabilities.
Exactly. And our mission here is to really explore the key features of Japan's macroeconomic and financial landscape. We want to pinpoint the major risks to its stability, assess how effective its policy responses have been, particularly macroprudential ones, and crucially draw out some policy implications, especially given, the current global economic climate.
Right. And the insights for this deep dive, they're coming mainly from a really comprehensive report by Ryan Kim, Japan's Financial Stability, from Growth to Vulnerability. We're also drawing on some significant work by Kawai and Takagi and detailed IMF reports, too. So solid grounding.
Absolutely. Good sources.
Okay, so let's unpack this. Japan's journey is, it's truly fascinating. It kicks off with this period of really rapid economic growth in the 70s, driven significantly by its thriving manufacturing sector, right?
That's right. And what's fascinating here, or maybe critical, is how the 1973 oil shock acted as a turning point, a real catalyst. Japan didn't just react, it responded strategically. It shifted towards energy-efficient production, heavily invested in advanced industries, think automotive, electronics.
So, Karen, here's where it gets really interesting, I think. The 1985 Plaza Accord, named after that hotel in New York where they signed it, this led to a sharp appreciation of the yen, a big jump. And the Bank of Japan's response, ultra-low interest rates. The idea was to help out exporters struggling with the strong yen.
But this raises a really important question. What were the downstream effects, the unintended consequences of that monetary policy?
It's exactly.
Well, it created this excessive liquidity, just, floods of chip money, and that fueled a massive speculative bubble, both in real estate and the stock market.
We saw the Nikkei index surge, right? Almost 39,000 points by 89.
Incredible numbers, and Tokyo real estate prices, they hit levels that were just, unprecedented, almost absurd.
And then, inevitably perhaps, in the early 1990s, the bubble dramatically burst. It triggered a banking crisis, a severe one, and that ushered in what we now famously call Japan's lost decade.
Right, a prolonged period of economic stagnation, deflation.
Yeah, it is painful.
And this lost decade, it wasn't just a blip, was it? It really shaped what came next.
Oh, absolutely. It forged many of the strengths, but also the weaknesses we see today. It's kind of the bedrock of this paradox we're exploring.
Okay, so let's fast forward a bit. Japan's still dealing with the fallout, and then bam, the 2008 global financial crisis hits. Now, what's really intriguing here is that Japan didn't have that direct financial meltdown like the U.S. or, many European countries. So why was that? And what did it actually mean for them on the ground? It's a key point. While they avoided that direct financial contagion, their banks were, relatively speaking, less exposed to the toxic assets. Their real economy got hit hard. The crisis basically ripped the cover off these long-standing structural vulnerabilities.
Like what?
Primarily an over-reliance on external demand. Exports were huge. And alongside that, persistently weak domestic consumption.
So no internal buffer when the global downturn hit?
Exactly. There wasn't enough domestic strength to cushion the blow. It also really highlighted things like policy inertia, reform fatigue, basically a difficulty in making needed changes, maybe a sense of weariness about constant reform efforts.
And that was made worse by?
A rapid yen appreciation around that time, which hammered export competitiveness just when they needed it most.
Okay, so the immediate results, what did that look like?
Well, a sharp contraction in industrial production, that was big. Bank capital got weakened because their stock holdings dropped in value. Lending capacity was limited. And you also had these lagging commodity price shocks, raw materials hitting later, which just added to production costs for firms. And this period, it really spotlighted a crucial structural shift that Kawai and Takagi pointed out. After the 97-98 Asian financial crisis, Japan's GDP actually became more sensitive to global shocks.
More sensitive to global, less to domestic. That seems counterintuitive.
It does, but it reflects their deeper integration into global supply chains, becoming a key part of how things are made worldwide. And that increased dependence on external demand just led to weaker domestic growth drivers over time, less happening at home, more tied to the world.
Which really sets the stage for the next big shock. COVID-19.
Right. Another significant hit. Japan's GDP fell by, what, 4.3%?
Yeah, and the government response was huge. Massive fiscal stimulus, over 40% of GDP, which is enormous.
Enormous. And the Bank of Japan doubled down on its ultra-loose monetary policy.
Stronger yield curve control.
Yeah.
What exactly is that, again, for listeners?
Basically, it's the central bank actively managing long-term interest rates, trying to pin them down at a specific low level, usually through buying bonds.
Got it. And increase asset purchases, too.
Yes. But despite all this stimulus, private consumption, business investment, they just stayed subdued.
Why?
Prolonged uncertainty, mobility restrictions, people just weren't spending or investing like they normally would.
Okay.
And the pandemic, it also sped up some structural shifts. More remote work, more automation, things that were happening anyway, but got a big push.
And then more recently, since 2022, a whole new set of challenges.
Exactly. Record global inflation hitting everywhere. And for Japan, a really sharp depreciation of the yen.
Falling to its lowest levels against the U.S. dollar in decades, right?
Yeah, really significant moves.
And this drives up import prices, obviously.
Yeah.
Triggering this, well, unusual inflationary trend in Japan.
Unusual is the word. Core CPI, that's inflation excluding volatile food and energy, went above the Bank of Japan's 2% target and stayed there for months.
So what does this all mean for them now, this weird inflation after decades of deflation?
It sparked this intense debate, about the future of Japan's whole monetary policy framework. The Bank of Japan is in a really delicate spot. They need to somehow balance controlling this new inflation with maintaining financial market stability.
Which must be incredibly hard given.
Exactly. Given the nation's record-high public debt and that persistently weak domestic demand we keep mentioning, it's a real tightrope walk.
Okay, but here's where that paradox really bites. Despite all these macroeconomic headwinds, all these historical challenges, Japan has, remarkably, kept its financial market relatively stable and resilient. How? What's the secret sauce there?
Well, it's partly this dual role Japan plays. It's still one of the world's largest developed economies. It continues to be really significant in the international financial system, providing stability, providing liquidity to global capital markets.
Through things like the Tokyo Stock Exchange?
Right. It's a major platform, regionally and globally. And don't forget the Japanese government bond market. It's deep, it's liquid, denominated in yen. That's a huge anchor.
And you've also got these massive domestic players, right? The institutional investors.
Absolutely crucial. The Government Pension Investment Fund, GPIF, it's gigantic. Insurers, banks, they form this incredibly robust foundation for Japan's capital markets. They add depth, they add resilience, they're committed long-term players.
Okay, stepping back a bit, what about the yen itself, its international role?
Ah, yes. The yen plays this really interesting international role, particularly as a key funding currency for carry trades.
Explain carry trades again, quickly.
Sure. It's basically where investors borrow a currency with very low interest rates like the yen for many years and then invest that money in assets denominated in a currency with higher interest rates. They profit from the difference, the carry. And the yen became the funding currency for this, especially after 2010 when Japan really committed to zero rates.
So it's not quite the U.S. dollar.
No, not a dominant reserve currency like the dollar. But it functions as a kind of quasi-reserve asset. Central banks hold a lot of yen for diversification. It's consistently in the top 5 global reserve currencies.
And it acts as a safe haven too, right, during crises?
Historically, yes. During the GFC in 2008, during the initial COVID shock, the yen often appreciated as investors fled to perceived safety. That's been a key characteristic.
Okay, so you have this strong, internationally significant financial sector, the safe haven yen.
But, and this is the core tension, it brings us right back to the paradox. Japan's real economy faces these persistent structural challenges. Long-term stagnation, that aging and shrinking population, a labor market that's often seen as inflexible.
And these weakened domestic demand.
Profoundly. They reduce the economy's ability to react dynamically to shocks, whether they're domestic or external. And these macroeconomic constraints, in turn, they've diluted the effectiveness of policy stimulus. You pump money in, but it doesn't quite get the traction you'd hope for because of these underlying issues.
Right. It's like trying to drive a car with the handbrake partly on.
That's a good analogy, actually, yeah.
So, okay, let's pivot to the future then. What are the big storm clouds on the horizon? The report identifies several critical, forward-looking systemic risks. First up, the absolute elephant in the room, that extremely high government debt.
Yeah, you can't ignore it. Public debt around 230% of GDP. It's just the highest among advanced economies by a long shot.
And the concern isn't just the level, but the trajectory.
Exactly. The IMF projects that Japan's interest payments on this debt could potentially double by 2030 and maybe quadruple by 2036.
No.
That poses a severe long-term risk to fiscal sustainability. It really limits the government's firepower to respond to future shocks, another pandemic, a natural disaster, a global recession.
And the act of normalizing monetary policy itself, raising interest rates eventually, that adds risk too.
Oh, absolutely. It creates risks through interest rate channels, higher borrowing costs for the government, and market valuation channels as bond prices adjust. It's another layer of complexity.
Okay, beyond the debt bomb, what's next? The report talks about potential liquidity tightening linked to those carry trades.
Yes. This is about vulnerability to exchange rate volatility. We saw that huge yen depreciation in 2022 and again in 2024. Driven largely by the widening gap between Japan's ultra-low rates and rising rates elsewhere, fueling those carry trades.
So the risk is if that reverses quickly.
Precisely. A rapid unwinding of those leveraged yen funding positions may be triggered by a change in rate expectations, or a sudden shift in risk appetite could cause disorderly foreign exchange adjustments. Think widespread market volatility, sudden capital outflows from Japan, and that risk gets magnified if global liquidity conditions are tightening anyway. It could spread.
Nasty potential feedback loop there. Okay, risk number 3, credit risk, specifically from SMEs, small and medium enterprises.
That's right. Many Japanese SMEs got really reliant on cheap loans and special support programs during the pandemic. Lifelines, basically.
And now those are being phased out.
Gradually, yes. But as they are, and if borrowing costs rise and domestic demand stays weak, you could see a wave of bankruptcies among these smaller firms.
But Japanese banks are generally well capitalized, aren't they?
They are overall. But even so, a significant deterioration in asset quality, lots of loans going bad, could still have negative spillover effects. It could tighten credit supply more broadly, hit investor confidence. So yeah, SME credit risk is a really critical area to watch for stability.
Makes sense. And finally, the report flags Japan's external risk profile, trade concentration, geopolitical friction.
Right. Connecting this to the global picture, Japan's export structure is heavily weighted towards things like cars, machinery, electronics. Economists call them income elastic, durable, and capital goods. Meaning demand for them is very sensitive to changes in income and economic cycles. When global growth slows, especially in the US and Europe, demand for these Japanese exports tends to fall sharply.
So very vulnerable to global downturns.
Highly vulnerable. And beyond just economic cycles, there's increasing exposure to geopolitical tensions. Trade fragmentation.
The U.S.-China dynamic.
Exactly. Escalating trade friction there, growing restrictions on high-tech exports. These pose significant risks to Japan's key industries. Auto, semiconductors, industrial machinery, they're caught in the middle sometimes. Plus, Japan relies heavily on intermediate goods, trade components moving across borders, and its companies have expanded massively overseas. This just amplifies their exposure to any global supply chain disruptions or instability.
And hanging over all of this, the demographics.
Always the demographics, that declining and aging population. It weakens the domestic consumption base, limits labor supply, puts huge pressure on public finances through healthcare and pensions. These are fundamental structural constraints that just undermine long-term growth potential and make it harder for any policy, monetary, or fiscal to really work effectively.
Okay, so given this complex web of domestic weaknesses and external threats, what's the path forward? What does this all mean for strengthening Japan's financial resilience?
Well, the report really stresses that stability is looking increasingly uncertain. It's this tricky interplay of domestic vulnerabilities and global risks.
Compounded by exiting that long era of ultra-loose money.
Right. Alongside the ongoing structural issues and rising geopolitical heat, it's a tough mix.
So maintaining stability requires
a really comprehensive, well-coordinated policy approach. It's not just one thing. The core challenge is finding that delicate balance. You need to gradually normalize monetary policy without spooking markets, while simultaneously tackling those deep-seated structural weaknesses in the financial system and the real economy.
Which demands
a strategic combination, really. Macroprudential regulation, those safety tools, institutional reform, and managing those external risks.
Okay, let's break that down. Strengthening domestic resilience first. What does that involve?
Responding to those structural challenges head-on. Population decline, weak consumption, the unwinding of pandemic support. A really clear, well-communicated path for monetary policy normalization is vital. You need to guide market expectations carefully to avoid overreactions.
And support for regional banks. You mentioned they were vulnerable.
Yes, crucial. They've been squeezed by years of low rates and low profitability. So support through maybe capital strengthening, better risk assessment tools, perhaps encouraging some strategic consolidation or integration where it makes sense.
What about those macroprudential tools?
Need to enhance them further. Things like countercyclical capital buffers, making banks hold more capital in good times to absorb losses in bad times, and more targeted sectoral stress tests to spot where risks might be building up in specific areas.
And the long game.
Long term, you have to keep pushing on structural reforms, addressing labor shortages, finding ways to revitalize domestic demand, tackling the fiscal pressures from aging. There's no escaping that.
Okay, that's the domestic front. What about externally? Stabilizing trade and currency.
Increasingly important, especially as global markets get more volatile with trade tensions and central banks moving at different speeds, Japan needs to manage exchange rate volatility, probably through active surveillance, maybe interventions if things get disorderly, to keep exports competitive and avoid sharp, damaging swings in the yen.
And keep an eye on those carry trades.
Definitely. Closely monitor those yen-leveraged activities and short-term cross-border capital flows. They can really amplify disruption when sentiment shifts quickly.
What about trade strategy?
The report suggests promoting diversification, deepening regional integration, maybe expanding free trade agreements with emerging markets to reduce reliance on just a few big partners, and also encouraging reinvestment back into Japan in strategic sectors, semiconductors, green tech, to reduce vulnerability to global supply chain shocks, build more resilience at home.
And international cooperation.
Essential. Close coordination with partners like the G7, ASEAN nations. It's vital to guard against financial fragmentation. The world splitting into separate financial blocks and manage currency imbalances collaboratively.
Right. And finally, this brings up a really important point about overall crisis preparedness. The report advocates for a more integrated approach.
Yes. Coordinating monetary, fiscal, and macroprudential tools much more tightly, bringing them all under a unified financial stability strategy. This kind of coordination is critical when you're facing frequent global shocks, pandemics, natural disasters, geopolitical flare-ups, capital flight.
So building better frameworks before the crisis hits.
Exactly. Proactive crisis response frameworks, things like pre-planned emergency liquidity facilities, building up risk buffers in good times. It shortens response times and maintains confidence when things go wrong.
And fiscal discipline still matters.
Hugely. Maintaining a credible plan to reduce that massive debt over the medium to long term is key to preserving policy space for the next emergency. You need some ammo left in the locker.
Plus, transparency, data, digital infrastructure.
All part of it. Transparent communication, data-driven decisions, better digital systems, they all enhance the agility and reliability of policy responses. Ultimately, it's about strengthening institutional consistency and forward-looking risk management to withstand both domestic imbalances and those inevitable global upheavals.
Wow, what an incredibly insightful and somewhat sobering deep dive into Japan's unique situation. We've really seen this picture emerge. A nation acting as this vital anchor in the global financial system, providing that crucial liquidity, that safe haven, yet at the very same time, wrestling with these profound, deeply embedded domestic structural challenges.
Indeed. And the core revelation, I think, the critical disconnect highlighted here is how the effectiveness of Japan's global role, its contribution to stability, is fundamentally limited, maybe even undermined by those internal weaknesses. It's just a really stark illustration, isn't it? How domestic fundamentals ultimately shape and constrain a nation's international influence and resilience.
So when we look ahead, the bottom line for Japan's future stability seems pretty clear. It's not just going to be about clever macroeconomic management or fine-tuning regulatory tools.
No.
But, most critically, it hinges on their ability to actually enact those difficult, long-overdue structural reforms.
Precisely. That's the crux of it. Without genuinely strengthening those domestic fundamentals, reigniting growth, making labor markets more dynamic, achieving real, sustainable fiscal health, even Japan's incredibly robust financial system might just lack the necessary buffer, the resilience against future shocks, especially in what looks like an increasingly volatile global environment ahead.
Which leaves us, and you listening, with a really provocative thought to consider. As Japan navigates this complex future, facing these quite unique demographic and economic pressures, could its specific blend of financial strength and structural vulnerability offer some kind of blueprint? Or maybe perhaps a cautionary tale for other major economies out there that are starting to grapple with similar demographic shifts and global challenges in the decades to come? Something to think about.